Imagine a giant company promising cheap phone calls to everyone. Now imagine it all crumbling like a house of cards. Billions vanish, thousands lose jobs, and trust in big business disappears. That's the story of WorldCom, a tale of glory, greed, and lies that cost investors over $180 billion. What if every phone call you made relied on fake numbers? Strap in, this is one of America's biggest corporate scandals. Let's go. The rise. Picture this, 1980s America. A small-town motel owner named Bernard Ebbers spots an opportunity to shake up the phone business. Long-distance calls cost a fortune, about $1 a minute. Ebbers starts a tiny company called Long Distance Discount Services, LDDS, in 1983, right from his office in Hattiesburg, Mississippi. His big idea? Offer calls at rock-bottom prices to businesses. From a motel room to a telecom empire, could one man really build a billion-dollar company? It did. LDDS grew fast. By 1985, it went public, so anyone could buy shares. Ebbers became CEO, and the company snapped up smaller rivals like a kid grabbing candy. By 1995, they renamed it WorldCom, a name that screamed, "We own the world." The 1990s were telecom gold. The internet exploded, everyone wanted faster connections, and WorldCom pounced. The crown jewel, the 1997 buyout of MCI, the second biggest long-distance provider after AT&T. This $37 billion deal made WorldCom a giant, serving millions with calls, data lines, and early web services. At its peak in 1999, WorldCom stock hit $64 per share. The company had 100,000 employees and $39 billion in revenue. Ebbers, once a basketball coach, now drove fancy cars and owned a huge ranch, even building an ice rink there. Why? Because he could. Ever dreamed of turning cheap phone plans into billions? WorldCom was that dream on steroids, but behind the glitter, trouble brewed. The dot-com bubble burst in 2000, telecom prices fell, and WorldCom had borrowed billions for deals, piling up $41 billion in debt. Revenue dropped 25%. Wall Street expected endless growth, but reality hit hard. Ebbers and CFO Scott Sullivan faced pressure to keep stock high. Loans tied to Ebbers' shares meant falling prices could wipe him out. Desperation crept in. Little did anyone know, this golden giant was about to fake its shine. The tricks. What happens when a company can't meet expectations? Some leaders cheat. At WorldCom, the tricks started small but grew into a monster. Think accountants are boring? Wait until you see how they hid billions like kids stashing candy from mom. It began in 1999. WorldCom missed earnings targets, those magic numbers that make stocks soar. Instead of admitting trouble, Sullivan ordered a sneaky switch. Normal daily costs, like line maintenance, are operating expenses. They hit profits immediately, like rent draining your wallet. But capital expenses, like buying equipment, get spread out over years, like paying for a car slowly on a credit card. Sullivan's team reclassified $3.8 billion in line costs as capital spending. Poof, profits looked huge. Outside the inner circle, no one knew. Controller David Myers and accounting director Buddy Yates entered the fake numbers into computers. Junior staff, like Betty Vinson and Troy Normand, felt uneasy. They followed orders, but hated it, even drafting resignation letters they never sent. Fear of losing jobs kept them quiet. One wrong number, and the books crumble at WorldCom, thousands of lies stacked up. By 2001, the fraud reached $4.6 billion. They faked revenues too, creating sham sales and tweaking reserves, funds set aside for bad debts. Reserves became a slush fund. Pump them up in good times, release in bad, and profits magically rise. Auditors from Arthur Andersen, later infamous for Enron, missed it all. Why? WorldCom was a big client, and oversight was lax. Ebbers claimed ignorance, but emails and voicemails later showed he pushed for aggressive accounting. Sullivan testified Ebbers bullied him into it. The goal: keep stock above $15 to protect Ebbers' $400 million in loans. Between 1999 to 2002, the scam inflated assets by $11 billion, bigger than Enron. Internal warnings begged for ethics training, ignored by top brass. Hiding billions isn't rocket science, just bad math with greed. But how long can a house of cards survive before the wind blows? The collapse, June 2002. The air in WorldCom's Mississippi HQ felt heavy. Cynthia Cooper, VP of Internal Auditing, sensed something rotten. Her team, including Gene Morse and Glenn Smith, worked nights to avoid prying eyes. Morse examined prepaid capacity, a strange line item. What was it? Nobody could explain. One brave accountant with a calculator versus a web of lies. Who wins? They found it. $500 million in fake entries from 2001, then $3.3 billion more. Line costs, pure expenses, disguised as assets. Cooper's heart raced. She confronted Yates, who shrugged. Myers stonewalled. Sullivan begged to delay the probe until after quarterly reports. Red flag. Cooper refused. On June 17th, she briefed the audit committee. This is bad. The board called the SEC. June 25th. WorldCom drops the bomb. $3.8 billion overstated. A $200 million profit was really a $700 million loss. Stock plunged 60% to 99 cents. From Wall Street darling to penny stock in hours, a freefall of epic proportions. The SEC sued for fraud June 26th. More dirt surfaced. Reserves manipulated, revenues inflated. Total restatement, $11 billion from 1999 to 2002. Panic spread. Suppliers demanded cash. Debt loomed at $41 billion. July 21st, WorldCom filed Chapter 11 bankruptcy, the largest in U.S. history at the time, surpassing Enron. 17,000 jobs cut. Ebbers ousted, Sullivan fired. Cooper became a hero, but threats followed. Drop it, Whispers warned. She didn't. Morse traced unauthorized spending. The collapse rippled. Markets wavered. Trust shattered. When truth surfaces, empires crumble. WorldCom wasn't just broke, it was built on sand. The fallout. The dust settled, but pain lingered. WorldCom's fraud wiped $180 billion from investors, pensions, savings, dreams gone. Your retirement fund played with by crooks? That's the nightmare thousands faced. Legally, heads rolled. Sullivan pleaded guilty, got 5 years. Ebbers, convicted in 2005, 25 years. Myers and Yates served time too. Vinson got 3 months house arrest, a light slap for her whistleblowing regrets. Arthur Andersen, already weakened by Enron, crumbled. The SEC fined WorldCom $2.25 billion, later reduced in bankruptcy. The name WorldCom buried forever. Cooper won awards, wrote Extraordinary Circumstances, and now teaches ethics. Ebbers died in prison in 2022, still claiming innocence. In conclusion, WorldCom's saga screams a warning. Greed can blind even the brightest minds, while truth is the light that never fades. Imagine billions disappearing overnight because someone wanted fast success. One lie can topple empires. One whistleblower can change history. Rise high, but build on rock, not on tricks or shortcuts. In business, in life, fake it till you make it is dangerous. Fake it and you break it. Ethics aren't optional, they are your shield. Watch for red flags, mysterious expenses, strange accounting moves, pressure to hit the numbers. Boards must dig deep, audits must be fearless, and individuals must speak up. Cooper proves heroes wear headsets, not capes. Could you stand when the world looks away? Share this story with someone chasing shortcuts. Study socks, read Cooper's book, and remember, trust isn't built in a day, it's earned call by call. Which side will you choose, truth or lies? The choice is yours. If this inspired your wanderlust, Don't forget to subscribe, share your thoughts in the comments, and stay tuned for more content. Thank you.